Good morning, everyone. Welcome and thank you for joining our Monday webinar call for 16 June 2025. Today, we have few counter updates, results for Adobe Inc. Zixin Group, some updates for Apple and PropNex, the usual technical analysis on S&P 500 and few others. Finally, macro outlook for Singapore Banking Monthly and Singapore Weekly update. Moving on to the next slide is our usual disclaimer. Please note that everything we present is from the public sources and serve for education purpose only. So please do reach out to your financial advisor before you make any form of investment. So let's begin with Adobe earnings result for second quarter 2025. As the title suggests, the revenue beat the top end of the guidance. Adobe result met our expectation at 49% and 50% of our FY25 revenue and adjusted PATMI forecast accordingly. For the first positive point, Adobe revenue beat the top end of the guidance. In the second quarter, Adobe's revenue rose 11% year-over-year to $5 billion, which is about 1% above the top end of the guidance and market consensus. Revenue from the creative and market professional, which is the smaller section of the Adobe, which make up 72% of total subscription revenue, rose about 10% year-over-year to $4 billion, supported by strong adoption of generative AI across Adobe's creative tools. Adobe product users have generated over 24 billion assets with Firefly, which this amount is up from 20 billion in the last quarter alone. And the next business segment, business and consumer subscription revenue, climbed over 15% year-over-year to $1 billion, led by Acrobat and Express. The monthly active users, which is the user engagement metric for these products, which is accessed through mobile apps, web browsers, and desktops, grew by 25% year-over-year, crossing 700 million users, and this is increased from 23% year-over-year growth in the previous quarter. Second positive point is the margin that remains strong. Gross margin for the second quarter held steady at an impressive 89%, sustaining its first quarter level and also rose by 40 basis points year-over-year. Operating income, on the other hand, rose 12% year-over-year to 2.1 billion as margin improved 40 basis points year-over-year to 36%, driven by strong top-line growth. For the outlook for the next quarter, Adobe expect total revenue to increase by 9% year-over-year, continuing their steady growth. The digital media segment revenue is projected to grow by 10% year-over-year, driven by subscriber gain and revenue growth across its creative tools. For the full financial year of 25, Adobe slightly raised several targets. This includes total revenue, which is up by 0.5%, digital media revenue, which is up by 0.6%, and adjusted earnings per share, which is up by 1%. The company also reaffirmed its full-year guidance for digital experience subscription and segment revenue and the digital media ending annualized recurring growth. Management attributed their higher targets to strong performance in the year's first half. Meanwhile, management highlighted that the revenue from its AI-first product, that is Acrobat AI Assistant, Firefly, and Gen Studio, is on track to exceed the $250 million target by the year end. To conclude, we maintain a buy call for the Adobe with a higher target price of $560 from previously $543. The higher target price is due to the higher financial year-end target raised by Adobe due to the excellent performance in the first half of the year. We observe that the company is experiencing steady user base growth, fueled by fast and easy-to-use AI tools that users increasingly like. And we view that the upward guidance revision reflects management confidence in the continued steady performance for Adobe, driven by the higher subscription revenue. That is all from me. I will pass the floor to Helena.
Thank you, Fahmi. I'll take it over for Apple. So Apple, this one is basically an update for their Worldwide Developer Conference. So for the conference, for those who are not very familiar with Apple, this is their annual conference. So this is the conference where they usually will announce the new model lineup, the update for their operation system. So last year, the 2024 WWDC, they actually caused a lot of hype because that's when they announced their Apple Intelligence. So there has been a lot of deduction of what this year's WWDC going to be, whether it's going to be leaning more towards the AI like Google just did last month, or whether it's still going to be leaning towards more of the system update. So to our disappointment, they have very limited Apple Intelligence updates. So the several they do mention, one is the AI translator. So that is basically a real-time communication tool now, integrated into messages. So when you text people, they can help you translate. It's also incorporated into FaceTime. So when you're talking to video calling someone who's speaking a different language, they're going to be able to live translate what the person is saying and display as a caption on your phone. Another feature that they have is the visual intelligence. So that is basically whatever you see on your screen, you can directly ask your ChatGPT about what exactly is that. Or you can also try to cross-search it online. Let's say you see a product and you want to buy it, you can search the photo to see where you can buy it from. I guess the biggest highlight they have for the AI would be their LLM white paper. So it came out basically they plan to open its AI foundation model to developers. So that allows them to write their own features and software. So this is aiming to really enhance their AI-driven use cases on the iPhone and to really deepen integration across their broader ecosystem of products and services. The last one is what we expected them to announce because they've already rolled out Siri, but they're going to roll out another version which is smarter. We expected some update on that, but they didn't touch it at all. Another one we expected them to update would be the rollout of Apple Intelligence in China because they're trying to going through a lot of regulation problems. So that one they also didn't really comment on that. And the remaining are just going to be software updates. And moving on to the next slide. So for the software update, the biggest highlight they have would be the liquid glass. So that is really like a more on the appearance wise. So it's a new design where everything is going to be in a translucent layer. It's going to be more fluid animation. So this is really to make it like a more modern looking. But some people argue that because it's transparent, so sometimes you can't really see it clearly. So it's really just for appearance wise. Another update they have would be they're trying to rename all their system update to 26 because previously like iOS and Watch they have different series numbers. So now in order to avoid confusion, they're changing everything to number 26. So just this is basically a summary of all the features that they have. But just to touch on a little bit, so for iPhone, they start having call screening, so it's easier for you to screen out what are the spam calls. And there's also hold assist, that is when a call came in and you don't want to answer it right away, but you also don't want to hang up. So now you have a choice to hold it first and pick it up later. For map, they have AI suggested routes, so that's pretty understandable. Then for wallet, they added the airport feature. So now you have live boarding pass updates. And in the US, you can also use your phone as the digital passport. So for iPad, they're now doing the Mac-like windowing. So now you can do multitasking on the same screen, and you can resize the screen that you want it to be, and also the floating window. And for the MacBook, they were designing the control center. So now the Launchpad is replaced by Apple Library in Spotlight. And they're also doing some update for phone and journal apps via continuity. For Watch, they came up with a Watch Workout Buddy. So that is an AI-driven fitness coach with real-time encouragement, and they can try to pair the music to your workout. Another one would be the gesture control. So they now introduce a gesture called the wrist flick. So once you do it, you can either dismiss alerts or you can hang up calls. So for the vision, there's spectral widgets. So the 3D personas are made more real life. So it's almost as if you're talking to a real person. They're also having persistent AR overlay. So that is to continue the liquid glass visual trend. And for the TV, they have region-based screensavers. And they also have persistent AirPlay devices assignment for smoother multi-room use. So these are just the summary of the software update that they have. So all in all, we think the updates it kind of fall within our expectation. We didn't really expect a lot of transformative AI features, and especially they delay with the Siri, and so there's really not much. And the functions they do came out, the live translation and the visual intelligence, they are helpful. but they're not disruptive. They're also not significantly unique because rivals like Google and Huawei, they already have rolled out similar capacities before Apple. So that really underscores their lag in AI adoption. So last year there has been a lot of hype because they just announced the Apple Intelligence, and the reality is they have really yet to justify the hype because we're not really seeing a surge in the iPhone growth. Actually, for the first half of FY 2025 so far, the Apple shipment is actually flat, and we're seeing very limited signs of meaningful upgrade cycle ahead since they have no further updates. And this might, so we do expect this one to persist into the next product release. So that's going to put pressure on their revenue and brand vitality. And meanwhile, another big problem that Apple is facing right now is the China market. So they continue not doing well. The China market declined 7% year on year in their first half of FY 2025. This really reflect the competitive and macroeconomic challenges. So we do maintain a very cautious stance right now, especially with the rising geopolitical friction and the slow rollout of their Apple Intelligence in China. So we think all in all, while Apple's core service it remain solid, but with the elevated capex, the tariff risk, and weakening momentum in their key market, especially China, it's really likely to cap near-term upside. So our valuation remains unchanged. We maintain our recommendation of neutral with a target price of $200. So that's all from me. I'll pass my time to Glenn.
Okay, thanks, Helena. Yeah, so we'll be doing the banking monthly. The next slide, please. Yeah. So for the banking monthly, we just start off firstly with the interest rates for both Singapore and Hong Kong. For Singapore, wise the 3-month SORA, it continued to dip. It's quite a steady decline that we've seen at least over the past almost a year now. So it fell by 16 basis points month on month in May, as well as 137 basis points year on year. So this is, I think, the most significant year on year decline that we have seen since October of 2022. It's now currently at 2.31%. We do expect that it will continue to decline as more Fed rate cuts are expected, at least in the later part of this year, but maybe not as soon, not in the next few months, but definitely in the later part of the year. We do expect more rate cuts to come in. For the HIBOR, it did plunge quite drastically in May. It fell by 167 basis points month on month, and year on year it crashed by 247 basis points. So the reason for this is mainly due to the heavy capital inflows into Hong Kong, as from strong IPO activity and the investors shifting away from USD assets as the confidence in the USD and their assets eroded. And this pushed the Hong Kong dollar to the strong end of its peg to the USD, and it triggered the HKMA interventions to come in, and this flooded the market with liquidity. So that's the reason why we believe this crash in the HIBOR happened. However, we do believe that it will stabilize and it could bounce back up, but maybe not back to the same levels as it were the previous month, but at least there will be some kind of recovery. But with the current economic uncertainty, it's really hard to tell if whether or not the confidence in the USD it continues to dip. What will happen with the HIBOR. Now moving on to the next slide, we'll be looking at the loans growth. For loans growth, Singapore loans growth, it continues to hold above 4%, so still at this mid-single digit that we are anticipating for the rest of the year. It was at 4.5% in April, and this is still a slight decline from the previous month's growth of 4.8%. If you look at it, for the past 2 to 3 years, right, this is the 5th highest loans growth that we have seen. So the last 5 months, 4 to 5 months have actually been very healthy loans growth. Continuing for the rest of the year, we believe that it will still maintain at this mid-single digit level. For year to date 25, it was up 4.9%, so almost exactly at the mid-single digit level. But however, we do see that the loans growth will recover from the additional rate cuts and the declining Singapore interest rates. But then again, the consumer demand might be hampered by the trade war, so we could see some pullback, even though loans are more attractive at this current point with the lower interest rates. The banks are still guiding for mid-single digit loans growth in 2025. For the different segments, business loans were up by around 4%. I think the biggest improvement came from the manufacturing segment, which was up by 15% year on year. However, this is a bit of a lagging indicator. So this is April's figures, right? I think if we move on to the next few months, we might see this, especially the manufacturing segment, we might sort of pull back a bit, and we might not see such a healthy growth, at least for the later part of the year. Consumer loans were still very stable, growing around 5%. Housing loans, which comprises around 70% of the consumer loans, were also rather healthy, around 4%. Okay, now moving on to the next slide, we'll be looking at the current account and savings accounts, or in other words, in short, CASA. So the total deposits and balances, it continued to grow. It grew by 6% year on year in April. And the CASA proportion, more importantly, rose to 19.3%. So if you see this orange line here, that is the CASA proportion. It has been steadily growing for the last year, for the last six months. And this is mainly due to the fact that a lot of the higher interest fixed deposits have started to mature. So what consumers and customers were getting maybe a year or two ago, when interest rates were extremely high, you lock in your fixed D for about a year, right, at high 3 or 4%, right, and it starts to mature. So now they are coming out. But now when you're trying to put back into a fixed deposit, I think the max you'll be getting is around 2+%. So instead of putting it back into fixed deposit, most consumers will just park it back into their CASA and have this wait and see approach, right? To see, where can you place your funds? Is it maybe into an investment product? So that's the reason why we are seeing this CASA ratio continuing to increase. And this is very beneficial for the banks, because CASA is essentially the lowest cost of funds or funding cost for a bank, right? And the higher the CASA ratio, right, it means that their funding costs can be lowered. So that's very beneficial for the banks, and we expect this will continue to, at least this ratio will continue to increase, as more and more of this high interest fixed deposits start to mature and it gets placed back into CASA, as well as now that the rates have been on this continuous decline, it will be less attractive to put it back into a fixed deposit. Yeah, so this is one of the tailwinds for the banks. Now moving on to the next slide, we'll be looking at the SGX statistics. So in May, there was some pullback in the trading volumes, right? Because of April, it was extremely high, mainly due to Trump's Liberation Day, and the volatility spiked up in April. But in May, it pulled back slightly. So SDAV only rose by 6% and DDAV rose by 11%. However, if you look at year to date, I think volatility, at least for the first 4 to 5 months of this year, has been relatively high. So year to date, SDAV and DDAV did grow by 24% and 13% respectively. The VIX, which is the market index that we use to measure the implied volatility of the S&P 500 and the overall volatility, it only averaged 21 in May. So this has somewhat stabilized from the high of 32 that we saw in April. But we still believe that this heightened volatility could further increase for the rest of 2025. As long as Trump is still the president of the United States, anything could happen, right? Not just with the trade war, but with he's doing multiple things that will spike this volatility, and this will continue to benefit both the SDAV as well as the DDAV, and in general trading volumes. For I think the biggest benefactors would be SGX, and the banks will also be will benefit from this, as it will improve their trading and their markets trading income as well, as long as volumes are higher. For the top 4 equity index futures turnover, it dipped by around 7%, mainly due to a decline in the Nikkei 225 index futures. Now moving on to the next slide, we'll be looking at the Singapore banks' performance. So the share price of the performance of the local banks have recovered in May, right? It rose by around 2.7% in May. And this recovery, was not seen just by the banks, but across stock markets globally, as the initial shock from Trump's Liberation Day announcement in April started to wear off. And I think the banks were also, the main they also recovered quite well in May, right after his announcement. Moving forward, we do expect that we expect further recovery in the Singapore banks as their as they're guiding for stable earnings, and we are also anticipating stable earnings for the rest of 2025, and more importantly, that they have maintained their capital return initiatives. So they have not pulled back or lowered or even removed these capital returns that they're doing. So dividend yield is kept still at a healthy level, at least for the next 1 to 2 years. We also do we have raised the target price for the three banks, mainly from increasing the terminal growth rate estimate. So we raised it from 1% to 2%. This is coming from the banks, all three banks expanding regional footprint. They're expanding out of Singapore, the resilient profitability. So we are seeing, as I mentioned earlier, we are seeing quite stable earnings for the rest of this year, as well as more importantly, the strong reserve coverage. So when Trump came into power and he did all these tariffs and trade wars, we were thinking that there will be a higher, there could be a possible of higher NPL and loan losses. But then the banks came out to say that, okay, we actually have this huge sum of allowance reserves and management overlay that they have had since the COVID days, where they piled it on, and they haven't released actually majority of this. And instead of they're actually putting on more now, which is what we have seen in the first quarter. So that's why we believe that this strong reserve coverage is quite healthy for the banks. So for the three banks, we raised their target price. DBS is from $44.50 to $46.90. UOB from $35.50 to $36.30, and OCBC from $17.10 to $17.60. And our estimates as well as our ROE earning estimates all remain unchanged for the banks. Okay, now moving on to my last slide, I think. Yeah, so we do maintain overweight. We are now, I think, slightly more rate cuts are now expected, at least in the second half and the later part of the year. And we believe that the banks can maintain their net interest margins as well as their net interest income from the steepening yield curve, as well as the higher CASA levels, which I explained earlier. Loans growth is also expected to, I think, to slow down slightly in 2025. I think we're looking at the lower end of the mid-single digit target now. But the first order impact from tariffs is quite minimal for the banks, only at around 1 to 3% of total loans. And the trade war also does not directly impact the majority of the bank's customers. The bank's dividend yields are also quite attractive, as they have continued to return capital, and share buybacks will also improve the ROE and EPS. Yeah, so that's all I have for the banking sector. I'll now hand it over to Mel. Thank you.
Yeah, thanks, Glenn. So Zixin released the FY25 result last week. Next slide, please. Yeah, so the results outperform our expectation as the PATMI surged by 220% year-on-year to 42.7 million RMB in FY25. And for positives, revenue surged by 33% year-on-year due to increasing sales of processed sweet potato products. It rose by 24% year-on-year in FY25, supported by launch of new items such as sweet potato chips and also fries, and also 20% ramp up in their capacity. We also foresee sales of processed sweet potato products to continue to improve in this financial year, as Chinese consumers are becoming more health conscious, and Zixin is also boosting its presence through increasing market spending. There's also a new factory set to be completed by second half 26, and we expect sales volume to grow by around 33% year-on-year in FY26. Zixin is also expanding its cold storage capacity by around 25% by second half 26, and this is for fresh sweet potato products. So we expect sales volume to increase accordingly. However, average selling price may drop as sweet potato products is entering into a bearish cycle in FY26, following a 30% price increase in FY25. And sales for fresh sweet potato seedling increased by more than 200% year-on-year, as cultivatable area actually doubled last year. And Zixin is planning to double the cultivatable area again this year. So we expect sales for fresh sweet potato and also seedling to increase by around 27% year-on-year in FY26. And margin also improved by 2 percentage points to around 34% in FY25. And this was led by a 72% increase in sales of fresh sweet potato products. But we do expect margin to remain flattish in the upcoming financial year, as Zixin plan to trade off lower margin for higher sales volume for both fresh sweet potato and also animal feed. And for outlook, Zixin is spending around 16 million RMB in capex to expand its current capacity for fresh and processed sweet potato products, aiming to increase the market share through increasing their marketing spending. And we also expect cash flow from the Hainan rejuvenation project to start to contributing from FY27 onwards. And Zixin plans to replicate the entire value chain from Liancheng to Hainan. The quality and the yield of Hainan sweet potato is generally more superior compared to Liancheng. This will enable Zixin to achieve higher volume and also better margin. So we expect PATMI to at least double upon completion of the project. Yeah, so we maintain our buy rating with a higher DCF back target price of $0.06. And we also raised our FY26 PATMI forecast by 16% to 56.2 million RMB. Zixin's revenue diversification strategy continue to gain on traction, with animal feed contributing to additional 400,000 in revenue in fourth quarter 25, and margin of around 20%. Yeah, and Zixin is also in a very strong cash position. It's holding net cash of 32 million, equivalent to around 52% of the total market cap. Yeah, that's all for me. I will hand over to Ding for technical pause. Thank you.
Thanks, Maria. Good morning, everyone. I'll go on to the technicals. Next slide, please. Yep. So first up, looking at S&P 500, last week it was down slightly, 0.39% for the week. In terms of the price action, it broke down a rising wedge formation, which have been trading in since May, and also is currently doing a retest of the 5,970 level, which was a previous resistance from the middle of last month to the start of this month. Yeah, in also currently below the 10-day moving average, which it has been trading in above since end of May. So if we do breach the 5,970 level at the start of this week, I think we could see some further downside towards 5,870 level next. With the overall current resistance is at 6,000 to about 6,060, while support is at 5,760 to 5,870 area. Next slide. Yeah, so we have a technical buy for the iShares Russell 2000 ETF IWM at $211.90, take profit levels at $229.70, as well as $243.70, with a stop loss at $199.65. Last close price was $288.89 on Friday. Looking in terms of the chart, there was a breakout of a inverse head and shoulders formation. So the key neckline resistance was $209 and price broke above it. This happened alongside a breakout of a downtrend resistance line as well, coupled with a fresh bullish crossover at MACD. So with that, we could possibly see price coming out of this consolidation to trend higher towards the two take profit levels, which were prior resistances in February this year as well as December of last year. Next slide. Next one, we have a technical buy on SoFi Technologies at $14.48, take profit level $16.60, as well as $18.40, with a stop loss at $13.23. Last close was $14.09. So in terms of the chart, price has been consolidating in an ascending triangle formation since end of April, with a key resistance at $14.50, forming higher lows along the way. And MACD has remained above the zero line with a bullish crossover recently and increasing momentum. So this $14.50, which was a prior support breakdown level, if price can break out above it, we could possibly see price trend higher towards the two take profit levels. Next slide. Next one, we have a technical buy for Contemporary Amperex Technology, CATL, at $308.40 Hong Kong dollars. Take profit levels at $322.40 as well as $343.40 with a stop loss at $297. Last close price was $313 on Friday. In terms of looking at the chart, price has been pulling back after 2 days of initial spike since the IPO. However, looks like there was a bear trap formed below the $301.20 support level, where price subsequently closed back above the 5 and 10-day short-term move SMA resistances the following day. So we could possibly see price gaining some strength towards these two take profit levels back up. Next slide. Next one, lastly, we have a technical buy for United Health at $310.56. Take profit levels at $342 as well as $376 with a stop loss at $294. Last close was $313.53 on Friday. So in terms of looking at the chart, price has been consolidating sideways for quite a while. Recently, looks like there's some strength coming in as price is breaking off a downwards resistance line in blue, as well as is currently above some of the short-term at 5, 10, 20 SME resistances as well. So we could see some price recovery given the increasing momentum at MACD as well towards these two take profit levels. Next slide. And so this is my last slide, just to summarize the trades initiated earlier on. For the Russell 2000 ETF, IWN is currently down about 1.4%. For SoFi, it's down about close to 2.7%. For CATL, it's up almost 1.5%. As for United Health, it's up close to 1%. Yeah, so that's all from me. I'll hand over the time to Paul to give an update on PropNex. Thanks.
Yeah, thanks, Zane. So we issued a report this morning just to provide an update on PropNex. More launches in second half to sustain growth. So we expect growth to sustain at least for new launches, as the number of launches in the second half will be higher by 50%. Next slide. So in terms of the update, the highlights, we have 3 parts. So will be their new home sales. So year to date up to May, we usually exclude executive condo because those are lumpy. The number of units sold in Singapore was up about 163% to 4,000. Second half, we will see more launches because first half, the launch was only about 4,000 plus, and second half would be 50% higher, about 7,000. For new launches, actually, May was very soft. May, there wasn't any launch at all because of the elections, and June is also soft because school holidays, but that is seasonally soft. In terms of private resale, after the big bounce in 2024, the private resale actually grew at a slower pace, about 6%, but it's still within our forecast and even our PropNex guidance. The area that is weak in terms of volumes is HDB resale. So volumes has been weak, about down 6%. I think there are 2 reasons. Firstly, there's the fewer minimum, the MOP period, that 5-year MOP. So there are fewer units that reach the MOP. And secondly, with the higher number of BTO launch, then there's less need for buyers to go into the resale. They can just buy from BTO. So in terms of our outlook, we remain positive because the second half there'll be more properties to sell, especially July. July will be a huge number of launches coming up. But the only one concern that we have is that of the 7,000 being launched, about 1/4 is only in the OCR. So we know OCR or outside central region, that's where for the mass market, so-called mass market, I mean, everything is expensive nowadays, like 2,000 per square foot. But for the so-called mass market, where most of the buyers now are Singaporeans, that's where the take-up risks tend to be higher. And the remaining areas is more the RCR and of course CCR, and that more dependent. That's high end, more dependent on foreign buyers. We maintain our earnings. One way to gauge is always the next launch. Even when we speak to developers, they also tell us they can't gauge demand because demand is almost impossible to kind of calculate. But what they do take on is the response to the most recent launch. So after the 2nd April or so-called US tariffs or Liberation Day, where no sentiment could have probably collapsed, we have seen 2 launches. So the two launches were in the RCR and the take-up rates about 40-50%. Not on the weekend itself, but as of to date. So for us, we just take that as a signal that no sentiment is still generally healthy because these are the pricier RCR region. Maintain our buy, no change in target price. The fourth point is that the yield still is attractive. Right now, it's about 6%. And I think because PropNex can sustain this yield, which is about 48 million payout. Their cash flows is probably going to hit 60 million. And they, of course, they still have another 150 million of net cash to sustain any shortfall. And we probably think they will probably pay some special dividend. They already paid some of it last year, but there should be another batch coming this year. Of course, regulatory could be a positive. Again, this is all the speculation, but one regulatory catalyst could be the relaxation of the foreign buyer ABSD. Of course, the reason is why, but actually the inventory in the RCR, especially CCR, is building up, and there's a lot of launches. So if they don't kind of reduce the foreign buyer 60%, you're just going to get piled up more and more of these high-end properties, which is not within the reach of the in general the Singapore public. So we think that could be relaxed. Don't expect it soon. I think all the ministers are only just settled in. So probably our guess is probably after 6 months, then there could be a possibility like this of a relaxation of the foreign buyer ABSD. But the minister did mention that they are looking at the reduction of the wait-out period for downgraders. So what this means is that a person who sells the private property might, I think it's 18 months if I'm not mistaken, have to wait before they buy a HDB. So he did kind of mention that this is not cast in stone and they might relax. So this could be a sign of relaxation. But again, all this is speculation. Next slide. Okay, there's some charts on the volumes of the property market. On the left is the total volumes. The red line is secondary market. But the big spike you see here is the new launch. And new launch tend to be higher margins for most real estate agents. On the right here is just the HDB volume in beige, and the blue line is the price. So price is important because it will support the so-called upgrading, or lack of better word, from HDB to private. And the HDB prices since 2019 have been rising about 7% per annum. Next slide. Next slide. Okay, these are some our usual macro highlights, some of the key macro data that came out just for everyone's just to update everyone. We did get some data out from the taxi, so it continues to decline, which has been declining for many years, 3%, but it looked a bit more accelerated this time around, about 6%. The largest in 3.5 years. But of course, ComfortDelGro still holds like a 60% market share, or 65%. The other thing to watch for land transport is rail stats, which is a benefit which will impact SBS Transit and of course Comfort. So at least we've seen some stable growth here. Like, I guess more and more people using MRT. In terms of some of the data points that we always watch is the export sector. So Taiwan exports is exceptionally robust. I'm not sure why, but it's like growing 30-40%. We think most of it is due to semiconductors and buying ahead of any trade restrictions. That's why the exports to US has doubled. Of course, these are largely semiconductors. South Korea, we saw the opposite. Actually, we think, of course, semiconductors did well, but I think the auto exports is starting to hurt them. So that's why their exports is a bit softer. In the US was all over the news. I think we also have some questions, but we do have the May CPI, which has been modest. I mean, everyone's expecting with the import tariffs, the inflation will start to pick up. I look at it a bit closer. Goods inflation is only up 0.3. Things like furniture, toys, not the usual Chinese products, footwear, phones, PC, they are either down or flat year on year. So really no impact on the tariffs yet. And the eggs, actually, the only thing that shut up was the eggs, up 41%. We'll talk about it later. Next slide. Next slide. So in terms of our tactical view, of course, the highlight will be the Iran-Israel conflict. Our investment strategy is basically not to overreact. Not sure that is that called a strategy or view, but firstly, we think this is a 20-year risk. Of course, this is it never escalated to this extent, but the Iran nuclear program has been around for 20 years. For us, so long as the oil fields and terminals are not attacked, I know there's been a refinery attack, but that is more for domestic. Then Iran's 1.7 million barrels of oil per day is not at risk. These are crude oil, not the because refinery is for gasoline, diesel that is used for their own domestic use. Anyway, OPEC has a 5 million spare capacity, and there's an OPEC meeting, I think, on the 28th of June. So any major reaction on the share price, we should expect OPEC to raise further their production quotas. The third thing is, our base case is that Iran's key strategy is to develop nuclear weapons rather than go to war. Because if they bring in the US into this conflict, then it only worsen it. Of course, the big risk is the Straits of Hormuz, where 18 to 20 million barrels of oil per day is actually transported. For us, we don't. I think it's almost suicidal in a way for Iran to close it, because they rely on the Straits too, and you will actually kind of instigate all the other countries, because so many countries rely on that for oil, so they might all join into that conflict too. Of course, the other thing is their proxies could attack Saudi Arabian facilities, which they've done so in 2019. But the one positive of this, if there is such a thing, but it just reinforces the arms race. So defense spending, so right now it seems it's the jungle rules where the strongest will secure their own interests. So every country looking at this will find the need to, I think, develop their own military capabilities. And of course, all this will be positive for ST Engineering. Of course, on the US-China trade talks, that there was nothing really positive. That's why the market didn't really rally that much. There was no details. It was more like maintain the truce, whereby US will accept Chinese students, and they might do a bit on and China will export more of the rare earths. It was just a truce, and there was no escalation. There's this so-called framework that they are discussing. We can only speculate that the details of it will only be released when Trump and Xi kind of meet. Some speculated dates, because there are some events here, could be September or November. Then that could be a timeline where they could actually announce some relaxation. We're not clear on all this speculation. Just one final word. We always get a question on Food Empire, which I think we also missed it. But the biggest macro surprise in 2025 is probably not the gold price rally, but the rally in the Russian ruble. So the Russian ruble is up 22%. And this is against the US dollar index, which is down 8% or so. This is like 2-3 times more than the depreciation of the US dollar against other currencies. So of course, this is one thing that will help Food Empire. In terms of some of the key events, we will have the FOMC meeting on the 18th June. They're unlikely to make any changes to the interest rates. We are supposed to have a YOMA webinar, but they just canceled it this morning. So apologies for those who have signed up. They are probably because there was some management event that they had to attend. We will try to get them back in. They wanted it the day after, but I think it's too short timeline. Okay, next slide. We also have our Singapore strategy for those who are interested. These are just some charts. If you notice, the yellow line here is just the taxis. They have been declining since the onset of Grab. So it's no coincidence that when the yellow line started to decline, the number of rental cars started to surge up, which is of course the ride sharing impact. The red line here is just a ratio. I mean, like how many rental cars to taxis, it continues to climb, which is not unexpected. The red line here on the right is just ride hailing, which continues to grow. So this is positive, and positive also for Comfort, because they do have the Zig app, and they do allow other drivers to be on the app. And the one on the blue line is just a reminder. I mean, nobody actually does street hailing, which is taxis. Next slide. So the next two, this is just on the inflation. If you notice the goods line, which everyone is eyeballing, the red line is still in like 0.4% up. So it hasn't really seen the tariff impact. The one on the right, of course, one of the reasons given is that there's maybe the importers have stocked up a lot. We do see some stocking up. The blue line is what, I think 3-4%. maybe in line with retail sales. So it's not like they stocked up excessive. There was not like a huge excess inventory. We'll just look at this data, which is the retail inventory. Next slide. Okay, my last two slides is just on coal because there was some news and some questions that we had via email that China said they would want to stop importing Indonesian coal, which is not a possibility because China usually buys Indonesian coal because they're low ash, less polluting, and they will blend it with their own production. But we do see some impact. We do see coal prices on the left here down about 21% year on year and 8% month on month up to middle of June. And of course, we do see the Indonesian exports slowing down and also China thermal coal imports slowing down. So thermal coal is what is used in the production, which is used for electricity. Next slide. Okay, so this is my last slide just to explain why the demand supply for coal is weakening. So if you look at the blue line here, you notice there's not much growth. So power consumption in China is a bit slow. So this is like -1 or 2% in China thermal power. So that means the demand for coal is also softer. And you look on the right here, this is this colorful here. This is the China monthly production of coal. So while demand is down 2%, production is up almost 8%. So that's why you got this mismatch in China's demand supply for coal. But anyway, we still have a buy on Geo because production is doubling this year. So even though price may be down, I think it will more than offset by the doubling of production. So for us, no change in our view on Geo, but just to let you know that the sentiment should be a bit weaker because of the weak demand supply coming out from China. Okay, I think that's it for me. I think we can move on to Q&A.
Yeah, maybe I'll go first. Yeah. The first question here is bank stocks appear to be on decline over the past week. Any possible reasons? Thanks. Yeah. Yeah, it's a good question. I think if you look at the decline, if you look over the past week, of course, it has slightly pulled back, from it bounced back up really fast and then it went to, I think it really surpassed that pre-Liberation Day levels and then it dipped slightly. So I think if you look at, if you look more a longer term wise, right, it's still, it's still at almost I think it's very near their all-time highs for the banks, right? They pull back slightly, it might be some, I think my best guess would be some profit taking, but it's not really any big news that has come out, for that will sort of impact the banks basically. Yeah, so I don't think it's anything to worry about because it's just it's really quite a small pullback. If you look at a larger picture wise, there isn't really, it's not like a huge dip that we saw, I think the most significant one would be the Liberation Day, COVID, this kind of things really we saw a huge decline and there are reasons for it, right? Whereas this is more just, I think just normal movement of the stock price. Let me see. Yeah, is SGX overvalued and what are the key drivers? Is it time to is it time to accumulate and take profit? I think that's what the question is. Yeah, overvalued wise, I don't think it is. For SGX, the key drivers would be trading volumes. It's always been trading volumes. And now we have seen that trading volumes have really bumped up, right? He has gone very high, mainly due to the the Trump administration, right, and whatever he's doing has increased the trading volumes tremendously, and that'll be one of the key drivers. However, for SGX, I think that the main difference and I think something that they're going to be looking at quite closely and they should be looking at would be their dividend policy. They have held for quite a while now, right, that they want to hold a stable dividend policy where they pay out a set amount in good times and in bad times, right? So in bad times, of course, it will be great for investor because you hold it on to their stock, and they're not doing that well, but they're still paying, a certain amount. But in good times, you see that their profits and their revenue has all surged, right? especially like now, right? But their their dividend is still pretty low, you know, because they don't pay it, like it's not pegged to their earnings. So I think that's one of the biggest things that they will need to take a look at. And I think speaking to the management and the CEO, right, they did say that, okay, I think that's something that we will have to take a look at, because that is what their investors and shareholders are actually sort of giving feedback on, right? Yeah, so I think that's for SGX. I don't think it's overvalued at this point. It's still pretty decently valued. I don't know whether I got any more. Oh yeah, the GE one, correct. So can you give an update on the GE offer? What will likely happen? Yeah, so just a brief update. They did increase their their offer price, their offer price. This is the first, I guess, the new one that they have done, right? So just to note that if you have accepted the previous offer, right, and because that's close to it, they've really paid out, and you know everything's done with the first offer. So you won't be able to get it. You won't be, if you really accepted the first one. The second one is only for those that have not accepted. Basically, those that have held out. And I think the main update is that this is finally now fair and reasonable, right? So they will. I think it's highly likely that they will be able to get the sufficient amount of own shareholder. Sorry, they'll be able to buy enough of get enough of the shares before they can officially delist GE. I think that is my opinion, at least. But then again, I'm really not sure what that single largest minority shareholder is thinking as well. Whether or not this offer is enough for them. I'm sure OCBC, and GE have had talks with them, and had come to some sort of conclusion. Because if this single largest shareholder, minority shareholder holds out, right, then they will not be able to delist GE. Right, but now they bumped it up quite high, I think 17% higher. Yeah, so if they do accept, right, then they will be able to finally delist GE, and envelop it fully into their OCBC group. Yeah, so I think that's likely what will happen, unless that one group, right, holds out, and they're still not happy with this higher offer, which surprisingly enough, like if you ask them 6 months ago, or even 3 months, 6 months ago, right, OCBC were very adamant that no, we're not going to do anything. We're not going to give any offer or anything. That is the offer they gave 1 year ago. But now they have started to eat their words, and then now give this new offer. Yeah. So I think likely that is what will happen, that they will be able to delist finally. Yeah, so we don't cover HSBC, so a bit hard for me to comment on HSBC. But let me try to take a look at it and see if I can give some comments. Just let me see whether there's any more last few ones. Yeah, someone else. Actually, I'm looking to accumulate more. I'm not sure whether this is regarding which counter. Maybe it's SGX or the banks. Yeah. Oh, banks. Yeah, okay, yeah, it's the bank's dividend yields are really very healthy. So we will be able to, like, I mean, maybe I didn't mention earlier, but let me just mention it now then, that amongst the banks, right, because you look at all the banks right now, the three Singapore banks, they are all pretty equal in terms of earnings growth, right? What they're doing is that whatever excess that they have profits, they will just put it back into allowance coverage, because they are trying to prepare for this like doomsday or black swan event, which is what they're calling it, right? If the whole world crashes, at least they have this amount of money, right, to cover for loan losses. So that's what they're doing. So it's quite, I think it's all pretty equal, right? Before that, when before this whole Trump trade war thing, I think we were looking at both OCBC and UOB, because they were, we were expecting a bit more growth from them, whereas DBS was a bit lackluster because of their global minimum average tax, which would hit them instead of the other two, right? Because of where their assets are placed, and where they sort of pays their earnings, right? But then now that everything is equal, you look at it, all earnings will be pretty flat, right? For at least for 2025. Then DBS would be our topic mainly because of that, the fact that they have this fixed DPS, dividends per share, right? Whereas the other two is floating and semi-floating. So DBS, you know what you're going into. Even though earnings will drop, they will still give you that, $3.06 for FY25. Whereas the other two, if earnings does dip more than we're expecting or more than anyone's expecting, then their dividends will decline as well, because it's floating. It's a 50% to 60% kind of dividend payout ratio, right? So that's why when everything is equal, right, you don't see much growth, then you go for the most stable one, which would be DBS. Yeah, I hope that will give you some clarity into the banks and maybe which bank would be the top pick, at least for now. Yeah, I think that's all I have for. Yeah, okay, there's one in the chat from Ian. Yeah, do you expect OCBC UOB to give quarterly payout? Yeah, no, I don't think they will change it to a quarterly payout. There's no reason. They have done this for many years. I think someone did ask, like we did hear a question maybe a few briefings ago, where someone like jokingly asked, why wouldn't you all follow DBS and do a quarterly payout? And they said that we've already done this for so long and it's been working. Why would we change it? And I also think there's a lot of other not just regulatory issues, but also they need to go through their board, ask for a lot of permissions and a lot of red tape before they can change it from a half yearly to a quarterly. So I doubt they will change it to a quarterly. They'll just stick with this half yearly. Yeah. Okay, that's all for me. I'll just hand it over to the rest of my colleagues. Thanks.
Hi, I'll take some questions. Darren is on leave, yeah, so I'll cover him for some questions. You were positive on retail subsegment of S-rate, but restaurant and retails are not doing well. Has your view on the subsector changed? And please comment on CICT, FCT. Yeah, so we remain constructive on retail subsector due to the pretty muted supply in the market, and also although there's a lot of F&Bs closing down, but a lot of the new F&B concepts, especially the new concepts from overseas market, is still having a lot of is still entering into the market. Yeah, so retail subsector is still doing well, and companies are guiding around low teens to mid-teens rental reversion for retail subsectors. Yeah, so we still remain positive on retail. And for FCT, they recently achieved rental reversion of around 9%, which is in line with CICT's suburban retail market, rental reversion. And tenant sales will continue to be supported by the CDC voucher. And also we believe it will be pretty resilient, especially with the muted macroeconomic outlook. And for CICT, it remains a very diversified portfolio, as it contains subsector and also suburban malls, and also downtown malls such as Ion and Plaza Singapura. Yeah, so they guided slower rental reversion, but for its retail subsector, it will remain at low teens. And a suburban mall will probably outperform downtown malls. And tenant sales, since tenant sales is weaker for the downtown malls. Yeah, hope it answers your question. And please comment on the age tenure and also of the industrial and logistic properties for Mapletree Industrial and Mapletree Logistic. How many percent is nearing expiry? Isn't it time to be concerned? Yeah, so for Mapletree Industrial, for its US property, all of them are freehold. And for its industry properties in Singapore, is leasehold, and the weighted average lease expiry for the industry property is around 32 years. Yeah, so it still has a pretty long time, yeah, before it expires. And for Mapletree Logistic, the weighted average lease expiry is around 40 years. And there's only 5% of the Singapore property is expiring in 20 years. Yeah, so don't think we should be worried about the land tenure currently. Yeah, but so the land decay will be factored into valuation since like the valuation for the property usually uses DCF approach. Yeah, and GTC will consider like several factors when they consider renewal, such as the master plan, Singapore's master plan, whether the place will continue to be designated for industrial usage. And also, they will also consider the anchor tenant business plan. Yeah, so those are the determining factor of the renewal. Yeah, hope it answers your question. And accelerated raise fund while PTE placement only, non to retail investor while preferential offering. Is the dilution substantial? And how are Extender Business Park doing now? They were previously not doing well. Yeah, so it's not very dilutive. Although the offer price is around $2.47 and current share price is 2.6, but the preferential placement, the placement is only 500 million, which is less than 5% of the market cap. Current market cap, if I remember correctly, is around 12 billion. Yeah. So they continue to guide rental reversion of around mid-single digit. Although like Australia logistic side is a bit slower in terms of its leasing activity. And they are also very selective in terms of divestment in Singapore. And occupancy for business parks remain muted. But it's an industry phenomenon. Yeah, it's not only applicable for Extender REIT. Since like there's a lot of supply in the market and but Extender rate is they are ramping up its occupancy rate for business parks. So for 3 Changi Business Park, they managed to bring up the occupancy rate from around 50% last year to currently like 70%. Yeah, so the business parks is improving for Extender rate. Yeah, hope it answers your question. And any reason why S rate has not been moving up despite that there are signs that the interest rate has been declining? Yeah, so this will be attributed to the recent macro and also geopolitical uncertainties, such as U.S. tariff and also the Iran war. So investor in the market generally adopts a wait and see approach. Yeah, so they are more inclined to hold cash instead of like investing, and also like for the 2 like best performing subsector which is like logistic, industrial, and also retail. Investors are generally like worried about like the impact of the special economic zone and also tariff for industrial subsector and also like data center. And also like for retail subsector, they're pretty much worried about like the sluggish retail spending and also like F&B sales. Yeah, so that's why there's a bit of like overhang on the share price. With war going all over the place, are there any S rate with asset in the affected areas? Not that I'm aware of. Yeah, like under our coverage, I don't think there's any asset to be affected by the wars. Now, thanks for the presentation on Zixin. Can you share what is your expected downside for Zixin? Yeah, so the expected downside for Zixin would be the selling price for sweet potato products. Since like last year, average selling price for fresh sweet potato actually increased by 30%. So even though and after the 30%, Zixin is expecting the sweet potato products to enter into a bearish cycle this year. Yeah, so they are forecasting a decline in selling price. Yeah, so but the downside for the decline in selling price is still unsure. Yeah, so even though like they are ramping up the cold storage capacity of around like 25%, but the sales, yeah, is still like unsure for this thing. And also like RMB is depreciating. Yeah, so it remain a big downside risk for this thing since like the sales is generated in RMB. And there are some question on SIA. Sorry, let me find the question. Yeah, can you comment on SIA price drop in relation to Air India? Is it attractive with dividend? Yeah, so for Air India, since it operates as an isolated entity, yeah, so any liability arising from the crash is likely to be compensated via the airline insurance. Yeah, so yeah, we don't think this would affect SAA much, but yeah, sentiment wise, it definitely will weigh down on the share price. Yeah, but the near term, the share price for the near term is very much is likely to be supported by its dividend. Yeah, and with Jetstar exiting, shutting down is like Asia, shutting down is Asia operation. We expect this to be the catalyst for Scoot, which is SIA's budget carrier. Since like Jetstar used to operate around like 180 weekly services, which is around like 3% of the Changi International Airport's total traffic. Yeah, so we expect this amount of the traffic, passenger traffic, to be redirected into Scoot. And Scoot has been operating under its break-even capacity for like around 2 years. Yeah, so we believe with Jetstar closing its operation, it should benefit Scoot in a certain degree. And Scoot is also ramping up its weekly flight to like to Indonesia and Japan. Yeah, so we believe they are able to get higher revenue from Scoot this year. Yeah, I'll hand over to rest of my colleagues. Thank you.
Hello everyone. I'll take on one questions about Alphabet and Meta. So the questions is about what's the impact on Alphabet after Google cut ties with Scale AI and the impact on Meta as well. Thanks. For this one, I mean in terms of revenue, I actually don't see much impact of it because the investment towards Scale AI is actually more focused on AI development for Google and AI development and talent recruitment for Meta. And then for Alphabet, I think moving forward, they actually will be able to shift their investment to other competitors. Actually, they did it before after they terminated the contract with Appen Limited before. And then they actually put the investment into Scale AI. And then since this happened again, I do believe that maybe they'll find the similar competitors for the investment, yeah, such as like labor box, etc. And then like say on the impact of Meta as well, since they're focusing on AI development and talent recruitment, I don't see much on the impact on the revenue. But then for Scale AI itself, since they're aiming for $2 billion revenue this year, but then Alphabet is actually one of their major client that they're actually aiming to invest like around like 200 million in this. So I do believe that they might impact some of their revenue because of this, and because other hyperscaler they're aiming to terminate a contract as well, such as Microsoft. So but then Scale AI actually have another advantage is that they do have a contract with in the defense operation. So I do think that their revenue still can be quite significant. It's just that after this all these hyperscaler maybe terminal contract, it might affect a little bit. Yeah, thanks.
Um, yeah. Thanks. Sorry, let me just try to answer some. Keppel moving up last week despite non-material announcement. Any reason? Yeah, there's no particular announcement. The only thing that was released was they had an investor day. They usually do it with the buy side. I mean, frankly, I haven't really gone through it. It's in their website. Maybe there might have been some positive comments there. But for us, we among the large cap that I cover, at least I think we are the most positive on Keppel. I think operationally we will see that turn around probably from the second half, from the new data set, from the new data center, from the rollout of the Keppel South Bay. Yeah, so these are the two main catalysts to turn around earnings, and also next year would be from the power imports. If I need to get the numbers right again, but at the same time, in the background, you're going to have some divestments coming up. And I mean, fingers crossed, maybe they would do the M1 StarHub kind of merger or disposal. So nothing new, but I think we are still very positive on Keppel, at least for me. Yeah. Thanks. Trump's tariffs and dodge does not seem to affect the inflation and unemployment rate. Is it due to the 90 days pause? Your views, please. The commentary is all over the place, but I think the general view is that everyone has stocked up ahead of the tariffs, and so far no one has actually raised price yet. And you probably have to do it cautiously because of Trump will be like complaining about it, yeah, causing some Twitter storm or something. Yeah. So, but eventually they will raise. But my own view is that the increase in inflation is so well known that I think it's probably going to go below expectations, and maybe give room for the Fed to cut rates. But regardless, we think the rally for REITs at least will probably come in at the tail end of this year at the very minimum, because as we mentioned before, power is going to be replaced by middle of June. So whoever comes in is just going to cut rates, because if you don't cut, the only way to provide relief to the US current fiscal position is to lower interest rates. I mean, and not affect the economy so much. So whoever comes in is immediately going to be the biggest dwarf and going to cut rates aggressively. What would be the impact on the US shares should the big beautiful bill Senate approval? You might see some movements on the bond yield, and just a reminder that there is no discipline. But I think this is really quite pricey. I don't think there'll be any major impact. The yields might move out a bit and then just shake a bit of confidence on the US market. We have some sequencing that we see in the market. I think firstly, you're probably going to see some cuts in interest rates. That's why the bond market is not going to collapse, because if I'm a bond investor now, you know there's going to be Fed rate cuts going to happen sooner or later. So I think that's why we don't really see bond really collapsing. Then yeah, so that's why I think it may not be such a big impact on shares. I think bond yields might nudge up a bit, but not that severely yet. For us, we think the scenario probably a 2027, 2028 scenario. Yeah. Sunly Environment has gone recently. Any room? Yeah. So, sorry. I didn't meet Sunly. I think the one that met Sunly was Sikban, and apologies, he's on leave today, so really no news. Any view on Banyan? Yeah, Banyan, we actually did notice the turnaround. We are also positive that they are getting more contracts, because the story for Banyan is not to use the balance sheet, but to secure more management contracts. And once you hit that scale, then you get a big turnaround. We are trying to meet up with them, but they so far no reply. And so we try and give you a better update, but when we try to get hold of them. Is Baltic too expensive? Not suggested buy considering dividend strong. Is it like, yeah, it was more of a special dividend about it. So I don't have the details of me. Sorry, I think Darren will have a better. He's also on leave, so Darren will have a better sense. So again, I'll have to apologize for not taking this on. What's the odds of Israel striking Iran energy facilities as well as Iran closing? We think it is low. If I'm not mistaken, I think President Trump has warned Israel before. Not to strike the export facilities because one thing Trump doesn't want is higher oil price, and I think that is not what any country wants. So the most of the ships actually travel through the border of Oman. So one scenario, if they really do that, it's almost like the last resort, and it doesn't really benefit anything. And then the whole world will be against Iran. So I don't think it's in their interest to kind of close it. But this will be the overhang of the market. You all see all kinds of headlines. I think some Iranian officials, which may or may not be important, mention of closing, shutting it down. I think that also got some impact. Will the current Iran-Israel conflict drive up oil price stay elevated, leading to the Fed not cut rate? We don't think so. I think OPEC will probably respond with lower oil price, with a higher production quota. I mean, that's our base case that OPEC will raise their production. And demand is not strong. I mean, biggest demand driver is China, and China not doing that well. And apparently, China has also a very well stocked inventory. So that's why the demand supply isn't that favorable for oil for it to really do this ultra spike. Yeah, of course there will be headline news of straits and all that, but if you look at this pure demand supply, it won't be there. Any chance of a rate hike? I'm very unlikely, because you got to think of the tariffs like a tax increase. It's like Singapore raised VAT by 10% immediately in day one. Luckily they didn't. Singapore is 1%. But imagine if Singapore raised VAT by 10%, then the MAS also raised interest rate. Then you're like really killing the economy. So I don't think that will happen for the Fed. They will just call inflation as transitory. The famous word, of course. Why hasn't PropNex already paid a special dividend? They will probably wait until they did pay one after the full year results in February, or at least they did announce. So you got to wait until the first half. Their anniversary is in July. Yeah. So maybe a bit patient. Sorry, but I think maybe they will release the results. June, probably middle of August. Yeah, then probably that will be the time. Vietnam hike alcohol tax, how big is a negative? Yeah, I think the headline will be negative, but the contribution of beer to the whole Thai Bev group is only 10%. Because especially after acquiring Fraser and Neef, so beer actually is not very important to Thai Bev. Again, the news flow will be there and all that. The reason is because when they bought tobacco, they also had a lot of interest expense at the parent holding level. So wherever earnings you get is be offset by. So the contribution is very small. So I wouldn't be too concerned of beer. Of course, spirits is the most important, but so far I think Thailand hasn't done anything. Will Samudra benefit from the current war? We did see some movement in container rates even before the war. I was a bit surprised. So actually container rates from China to US bounce back up like 12-15%. But the war may actually cause some nervousness and yeah, but it shouldn't, but yeah, but it might probably pop it up a little bit. Yeah. Because Samudra is container, so I don't think there's much container go through the straits. So container is mainly the Red Sea. Parkway Reed, sorry, I think that one either Meow or Darren can answer. Oh, sorry, I missed so many. Okay. Hi, Darren. Can you share your latest on Stornwick as of last week? Okay, Darren's on leave. Apologies, but I think we still like Stornwick. I think the ECB just cut rates. I think 2 weeks ago. Yeah. Any thoughts on Keppel DC? Do we expect further upside? How will the new REIT entrance link entity impact on existing REITs? And yeah, okay, this one we are not sure. I think the rumored dividend yield from the new entity data center IPO is about 7% yield. Most of the assets in the US. So I'm really not sure. I mean, I'm not sure if investors will switch or maybe when the year 7 might come down. So actually, I don't have a good answer for you. Yeah, on how this will impact. Yeah, but Capital DC going into the index, I think that's really a positive. So I don't think I think in a nutshell, you probably just move sideways because I'm not sure if people will sell Capital DC and then move some into this new IPO or the NTT IPO because that has higher yield. But most of the assets are in US. Okay, Koch Brothers secured a big contract from Changi Airport. Will this have a spill over to Alltech? Yeah, okay, no, okay, totally different business. So Koch Brother of the 999, like Baccarat 999 contract, their stake is 30%. So, and that is more Singapore construction. I think it's the Changi Airport. Nothing to do with Alltech. Yeah. Why Takraw fell after the gem? I think Takraw news is mainly the dividend when X. The rumored valuation for the rumored valuation for Gem Life is 1.5 billion. So you do 30%, so about 500 million, the Gem Life stake itself. Yeah. So, and of course, even after IPO may actually move up higher. So I'm not sure. I mean, Darren's on leave, but at 1.5 billion, their stake. Okay, this is Aussie dollar. So nowadays must do 20% of that. So yeah. So probably 1.2 billion. So 30%, about 400 million. That would be Takraw's stake in Gem Life. Is the US deal finally a done deal? Sorry, it's not. Got not much value add. It's the US steel deal. Yeah, it's apparently a done deal. Yeah. Any fundamental on Chime Circle? I think this one might have to ask Darren. I'm sorry. Ask Glenn because it's the US banking tech financial. Do you find Kimley a buy currently with the growth? Yeah, I mean, yeah, it's a bit surprising. We thought Kimley sales would be stronger, but actually the sales, I was surprised. I thought with all the vouchers, with maybe people going downsizing more to hawker food, it didn't happen. I think their revenue is pretty soft. Maybe with the vouchers be better, but revenue for Kimley actually best flat, and earnings down 14%. Like all F&B operators, the last 2 years and this year is going to be challenging because of the progressive wage model. I mean, basically minimum wage. I mean, let's call it progressive wage. But actually, because minimum wage is going to step up the next 3 years, and there's also a possibility that the authorities might extend it into the following year. So that's why I think F&B in the very near term, maybe take a step back for a while first, because they are facing revenue not growing and a lot of cost pressures with the PW and the progressive wage model. Yep. Okay. Let me. Since last Friday, most stocks are declining. At present condition, which area of stock should be a potential buy for long-term investment? REITs, Fed, banks. For me, for me would be the REITs actually. Yeah. For the next 12 months, I think, because we still take the view that interest rates definitely going to drop because to also support the US government's fiscal position. So, but any move will be probably at the end of this year. Yeah, that's my own thoughts. Yeah. I'll leave the rest to comment on. Hi, Paul. The last time we heard of Southern Alliance is going to rare earth mining in Malaysia last year. Any update on this? Yeah, so Southern Alliance don't really meet anyone. Yeah, we haven't seen them for 2 years. So they are like the mystery, like some of these listed companies are mysterious. I don't talk to anyone. So until they are willing to meet anyone, I really don't have any updates. But you're right, I think Malaysia has another big rare earth mining processing, at least, which is like the famous or infamous Linux. I'm not sure if I'm pronouncing it well. Yeah, but let me try to see if we can try to get them on. But again, they are not meeting anyone. If the Iran-Israel war getting more inclusive and bigger in scale, what's the implication? I think the bigger implication, although very low probability, is the other countries get involved. But I don't like other Middle Eastern countries get involved in this conflict. But I don't think anyone wants to do that. I mean, with the US, with Saudi Arabia, UAE all having good relations with the US, I don't think that will happen. But I guess that will be the worst case scenario if other countries in the Middle East get involved, which is I think the probability is I think really, really low. Last week Thailand announced there's a 90% excise tax on beer. Has this been priced in for? I didn't see that announcement, so apologies. I can't find that announcement. I'm not sure if there's actually they did reduce excise tax for wine and spirits, but I didn't see that on beer. Sorry. So, but even if that is true, like we mentioned, the impact financially will be quite muted, because beer is only 10% of group earnings. I potential properties listings. Is it a good read to invest? I don't have the details. Yeah. The NTT one is a bit clearer, I think, because that's nearer. IR prop, I don't have any visibility. Yeah. Thanks. I think I'll leave it to the rest if they got any other questions.
Yeah, I'll take the Chimes one. Yeah, Chimes. Yeah, correct. Yeah, so they just did IPO. So Chimes, it's where's the question? It's asking for about yeah. So any fundamental view? So this Chime is really more of it's really like a middleman kind of where they provide the service of a credit card, right? And then they earn that interchange fee. That's what they call it, right? Every time you spend, then they get a sort of fee. So in parts, it's a bit similar to those buy now pay later kind of services, right? But it's not buy now pay later where you pay in full, like it's quite similar to Klarna, where it's sort of it's just a credit facility, but they put it in under the fintech, so they're trying to disrupt the traditional banking system. It's still loss making, right? So that you have to take note of that. And I think when they IPO, it was at about 6x revenue, so it's pretty rich, right? A pretty high kind of valuations. I think the key risk mainly is, how much can they continue to grow their active member base, and also a lot of the regulatory changes, whether or not the traditional banks and the more, I guess, the bigger fintech firms, like you look at PayPal, Affirm and Klarna, whether or not they will come in to try to take market share, because they just need to offer the same service, and there's nothing protecting them, and they really have a much bigger customer base as compared to Chime. Yeah. And I think they don't also have any banking license, right? They are really just a middleman. They're depending on the banks to provide their credit facility, where they just provide the credit card. So it's really quite a bit of a risk, yeah, in terms of this kind of fintech. So whether is it just a hype, an initial hype where you see the share price go up right after the IPO. Yeah, I think there's one more about the special dividend of OCBC dividend after GE saga. Yeah, I don't think so. I really doubt there will be any more special dividend after the GE thing. They already gave the special dividend by returning the capital. Yeah. Yeah, I think that's all for me. Let me hand it to the rest of my colleagues. Thanks.
There's a question for Far East Hospitality Trust. Is Far East Hospitality Trust having high trading volume? Is it worth to invest for this rich stock? Yeah, Far East they only have like less than 60% free float. Yeah, so their trading volume is not substantial. And we have a buy rating for Far East. However, we believe RevPAR increment for this year will be at around low single digit. Since like they have a very high base last year, and also like Chinese consumers tend to down trade. Yeah, so their RevPAR will only be supported by increasing occupancy rate. there's like around 9% occupancy gap between the current occupancy and the occupancy for pre-COVID. Yeah, so we believe any improvement in RevPAR will led by occupancy growth this year. And there's also like several mass events such as the golf Life 2025 and also Semicon 2025, the mass event. Yeah, so this should support RevPAR this year. Yeah, hope it answers your question. Thank you. Yeah, I'll hand over to Ding probably.
Thanks, Mel. I'll go through the TA questions. Yep. So first question on AEM, I think probably it's trading in the range right now between like 120 to 130. Recently it tested the 130 resistance level again. Also an uptrend channel, short-term uptrend channel breakdown level retest as well. So I think we like to see some pullback towards close to the support area at 120 again. They might just trade sideways in the near term. Next one is on Bank of China 3988. Yeah, so for Bank of China, I think it's in a bit of a range currently as well. Yeah, just mainly trading about 440 to about 470 area. So recently another pullback, pulling back from the resistance again. So we might see some just sideways trading similar to AEM as well, just range bound. And next one is on Beijing Jingmen Clean Energy 579. So for this, I think it's continuing on its uptrend by side. It's just rather slow and steady. Still holding above the breakout level 247 to 250. So it's just doing another consolidation for now. But if I think it can break above 257, then it's likely to continue to go higher, maybe towards like 270 next. Yeah. Next one is on Sesua REIT. For Sesua REIT, I think also just moving sideways recently. So the rebound hit this resistance at the previous strong support level at 64.5 cents. Then we've just seen sideways at this 62 cents, about 64.5 cents for since middle of April. So I think that will still be just moving sideways going forward in this range. The next one is on OUE. I think it's also just moving sideways for now. Largely between 26.5 cents to 29 cents. So really to see a breakout above this 29.5 cents for potential move upwards to maybe 31 cents next year. But still very much range bound for now. Next one is on Fraser's Logistics and Commercial Trust. This one, some support now is at around 78 cents. Recently rebounded to a bit of a rebound towards 83 cents, where there's some resistance over there, a bit of a pullback. So I think we might see some a bit sideways consolidation right now. Some near-term support will be around like 80 cents to about 80.5 cents area. Where previously there was a bit of consolidation at the start of this month before price broke above this 80 to 80.5 cents area. So you might just do some slight pullback to test this level again and maybe just move sideways in the near term. Next question is on Mapletree Industrial Trust. Yeah. So this one I think still looking a bit better. I think still holding the breakout of this short-term downwards resistance line, and price is still holding some higher lows recently, some above some of the short-term MAs. So it's like 193, 194 is about I think it's the current support. So if you can hold this level, I think we might see some move upwards to test the next resistance, probably around like close to $2. There's some resistance over there. Yeah. Next one is on Zixin. For Zixin, I think it's moving sideways, but there's some a bit of a weakness recently because price is during the upwards move over here, price was above the short-term MAs, 5, 10, 20. Then I think last Thursday there was a price close below this the moving averages over here, where this 0.033 is currently a bit of a resistance. So if price continue to remain under this level, it might hit a bit lower, maybe to test 0.031. There's some which was previously a strong resistance, and there might be some support over here. So I think, yeah, if there might be some short-term pressure for now first, for price to trend slightly lower to test maybe 0.031 and just move sideways again. Next one is on Central. I think the uptrend is still holding strong, just very stable. So generally, I think last week there was a break of 150, generally trading in this uptrend channel over here. So I think for now, it's holding at the 10 MA level, 1.9. We might see some rebound from this level because this was the resistance level price broke out from on Wednesday. Then the next resistance might, if it tests the channel resistance again, might be closer to about 159, 160. Okay, the next one is on Zixin financial holding. So for that, I think still seeing a bit of a weakness since this 73 cents level, since the breakdown is still holding as a resistance, and just moving sideways, not much right now. So I think support at 69.5 cents to 70 cents will still hold. So we just sideways consolidation probably in the short term. Next one is on Capital Infrastructure Trust. What is the technical buy for this? Yeah, for Capital Infra Trust, I think generally it's slowly trending downwards right now. So I would think the next technical buy probably around close to 37 cents. Previously, there was some support around here. Yeah. So if you're looking to buy, I think 37 cents might be a level to consider. Generally, it's also very range bound. Next question, Yanzijiang Shipbuilding. Yeah, for Yanzijiang Shipbuilding, I think it's moving a bit sideways right now. But just generally maybe holding within this rising wedge itself. Price a bit of weakness recently, but it couldn't hold the 5 MA levels, also trading below the 10 MA, slightly below the 10 MA level. But there's likely to be some support over here around 219 to about 224 over here. So we might see some sideways consolidation over here. Yeah. And for sets, I think it's a bit of weakness. Recently, where price was below this channel support. That's around 312, and also this was a horizontal level as well. So currently doing a retest of this around $3 level, where previously was a resistance. You might see some bounce over here, but I think overall likely to see some near-term weakness given the breakdown. Also, price broke down below the 10 MA level, which it was trending up since the rebound from the April lows. Yeah, then the next support level to look would be around 295. Yeah. The next question is on Capital Corp. So for Capital Corp, I think it's still trending well. I think since the breakout of this 690 level, price has been there was a bit of a rally, then price moved sideways on lower volume, and then when the volume increased again, we see the price rally again. Yeah, still holding above some of the short-term moving averages. So I think it's still a good trend. We're likely to see price continue heading higher. I think the next key level will be at 745 as the next resistance. Next question is on WeHe. And so for WeHe, I think generally it's the resistance at around 47 cents, still very strong. But positive is that price was probably trending along this at higher lows along an upward trend line support. So probably it's a very large ascending triangle. So another pullback from the resistance currently, I think in the short term, it might hold this 43 to 44 cents area as a support. Then it might just consolidate sideways again. Yeah, then let's see when it try to test the resistance again. Apple DC REIT, I think, yeah, it's still looking okay. Still holding about this 225, 226 previous resistance level. So a bit sideways recently, but still holding above the horizontal resistance level as well as the 10-day moving average, 5-day moving. So we could see a retest of the 233 this swing high over here. Then there's a question on PropNex. So for PropNex, I think it's still a very strong uptrend, just trading within this uptrend channel itself. So a bit of a pullback from the channel resistance. So we might see some sideways over here, but I think support will be still maintained close to about 250, 253 to maybe 250 in this area over here. Yeah, then likely to continue trending outward slowly unless there's a breakdown of this channel support that's somewhere like 250, 253 around there. Next one is a question on iFast. So iFast, I think it's moving quite sideways recently. So the key resistance to try to break is 667. Positive is that there's a bit of higher lows along the way, like this trend line support. Yeah, but overall price has been just in a bit of a downwards trend since close to 880. Yeah, so we have a bit of a consolidation over here. This around 645 must hold. If not, we might see a breakdown of this upward support line that could bring price lower. So just a bit of consolidation right now here, but also resistance at 687 and lower highs still continue to form. So there's still a bit of weakness, just consolidating sideways right now. The next question is of Valuetronics as well as PropNex. Valuetronics, I think, is moving sideways still. But positive thing is that still maintaining the higher low at around 68.5 cents level. And we need to see a break above 70.5 cents, that would probably bring price higher, yeah, towards maybe at 72 cents. For PropNex also just moving sideways. But positive is that this $1.03 level, previously this support breakdown has held as a support over here. So price is attempting the resistance again, close to like 110, 111. So if we can hold a higher for now, preferably around like 105, then that's some positive signs for a consolidation of higher lows. Then that there could be a breakout in future if it tests the 111 resistance again. Yeah, so for now, I think just a consolidation, still some consolidation sideways first. Then question on RH Petrogas and Rex International, is the trend upwards sustainable? Yeah, so I think there's been a sharp rally for RH. I think it's nearing the previous swing high resistances. So previously over here it was 20.5 cents, and then it's also recent next at 21.5 cents. So I think over here likely to see some I guess profit taking or for the trend to reverse downwards, I guess. After such a sharp rally, we've seen in the past over here there's a sharp upwards move, and then afterwards it came down relatively fast as well. Yeah, so I don't think it's sustainable, I guess, after the sharp rally. Then Rex also around 23 cents, there's some recent, and next one is around 25 cents. Yeah, so also another sharp rally that will come down after it hits these resistances. The next question is on SIA Engineering. SIA Engineering is also a strong trend. I think for now, it's a bit moving sideways with a bit of resistance at around 315, about there. So I think it's a bit doing some consolidation sideways, but still very strong as it remains about the short-term MAs, like the 5 and 10 days MAs. So I think it might just move sideways now with some support around $3. Then on Food Empire, I think it's look likely to move a bit of a sideways, a bit the short-term momentum a bit coming off in terms of price action, whereas it's below the $1.81 this consolidation breakout level, as well as the 10-day MA rate, where price has been holding as support since start of May. So a bit of a momentum coming off, but I think most likely will just remain at most in a range. So it might come down to test like this 170, 173 level, then still hold as support, then just trade sideways. Yeah, so I think just taking a breather currently. Next one, Hong Leong Asia, still a strong trend. Generally a bit sideways right now, but still maintaining above this prior resistance. That's close to about 122, 123, and as well as the 10 MA level here. So I think it's still very strong. We could still see an upwards move, I guess. If it breaks over this 127, then the next resistance around 130. Next one, UOB. For UOB, I think generally very range bound right now. Some weakness as of now, as price was maintaining at $35 and see a breakdown Friday and today. So we might see some short-term weakness to test the next support level here, $34. Yeah, then we might see just keep moving sideways thereafter. Okay, then for HST, Lion OCBC, Hang Seng Tech, this one I think just moving sideways as well. Some resistance from 87 cents to about 89 cents. And just support coming in around 82 cents area. So generally very sideways trending right now. And digital core REITs, I think for digital core REIT, I think it's also moving rather sideways right now. So support generally around 50 cents area for now, and resistance at around 54.5 cents, 55 cents level. So I think for now it's holding this 50 cents level. Also, yeah, you can break above this 52.5 cents, then we might see it test the resistance at 54, 55 cents. Then just continue sideways. Okay, then I'll take one last one. What's the view on OCBC? I'll give a TA view on that. For OCBC, I think a bit similar to what we've seen with UOB earlier. So there was this also was consolidating sideways for a very long time. For OCBC, it was holding at $16, but a break of that on Friday as well as today, we might see some short-term weakness to test the next support at around $15.80. Then it might do some bounce from there. So I guess that's all for the TA questions. I'll hand back the time to maybe Glenn to take some of the questions. Thanks.
Hey, thanks, Zane. Yeah. Let me just, yeah. So, what's the view on OCBC, and also how will the investors benefit from the delisting of GE in regards to OCBC investors? Yeah. So for OCBC wise, they don't really have any inorganic sort of growth avenues, right? They did do some small acquisitions, when you look at the PT Bank, Commonwealth, Indonesia. Yeah, and but they are trying to grow, right? They are trying to grow the Bank of Singapore. They have been hiring quite aggressively in terms of RMs, is what they always say whenever we ask. Whenever even without asking, they will just say that, oh yeah, we hired this many RMs, and that they are seeing, I guess, more customers. That's why they need to hire these RMs, and they're also trying to push aggressively. In terms of net interest margins, net interest income, I think it's very similar to the other two banks, right? There will be a decline in both margins as well as net interest income from the lower rates. But I think the biggest thing for them, at least for OCBC, compared to the rest, would be that they do still have the highest CET1, which is the capital ratios. They still have the highest excess capitals amongst the three banks because really back to my first point where they have not really done many big acquisitions, right? Unlike the other two banks where they did do their Citibank acquisitions, and it took out a lot from their capital, right? The excess capital. Whereas OCBC, they're still meandering. They're not really sure whether they're going to buy anything or not. This means that there's a possibility if they want to lower their CET1 to the optimal level of 14%, that they could continue to pay out more even after what they have announced. So they have promised it for the 2 years. We could see it coming in more even after that 2 years is up, right? If they really want to lower their CET1 to their 14%. And then to the second point, which is asking about how will OCBC investors benefit from the delisting of GE. I think if you look at it, they already own majority of GE, right? OCBC owns, I think now it's more than 90%, 93% of GE. So the immediate and direct impact will not be felt so soon, right? There will not be any, I guess, immediate impact. Unlike when you look at how UOB and DBS acquired Citibank assets, right? It's immediate impact because they didn't have any, or they didn't have much presence in those areas, but suddenly they are taking on their customers. Of course, there might be some overlap. If you see, in terms of like, you look at Malaysia, UOB already has a pretty decent exposure in Malaysia. But when they took over the Citibank assets, right? You can see that there is some overlap where, maybe this customer has both UOB and OCBC Citibank credit card, sorry, then they will only keep one now, right? But of course, there's also a huge addition of just solely Citibank customers where they can onboard into their UOB platform. And these are not just customers that they're looking to sell a credit card to, but they can get deposits from them. They can also do loans with them. They can also do wealth management fee income with them as well, right? So that's the benefit of having this kind of inorganic acquisition. But in terms of GE, I think what the whole plan is for them to get GE, and they have like full control over GE without having to, I guess, without GE having to answer to shareholders, right? I mean, the main shareholder is still OCBC, but that they can envelope it into their group, and then everything can be a bit more, I would say, smoother, more integrated when they finally have GE as their insurance arm. So they can, maybe there might be some kind of rebranding, renaming, right? So that instead of being known as a separate entity, it might be known as like OCBC insurance or something. I have no idea. I'm just guessing here. But I think the plan is for them to fully integrate it into their OCBC group, right? So it's more of a medium to long term kind of investment, where we will see some of the effects. Yeah, but as of now, I think it's just for investors, the direct immediate impact is just to clear up this overhang, this mess that have been hanging over them for almost a year, right? Every quarter they will get a question about this, like, oh, are you going to settle it? Are you going to settle it? Right? And also to, I guess, to satisfy SGX Rashco as well, right? Because it cannot be kept there. The trading suspended for too long as well, because then they will start to ask questions like, you either do something, or you either go and put back the shares, to make it public again, or you just delist it. Yeah. So I think that is really more to just settle the whole scenario. Yeah. More of a medium to long term kind of target for them, for GE. I think that's all the questions. That's all the questions, I guess. Paul, do you want to end it, or I can just end it? Yeah.
Yeah, please. Yeah, thank everybody.
Yeah, okay, yeah. So I guess thanks again, everyone, for attending. I think we have managed to answer all the questions. So hope you have a good week ahead, and we'll hope to see you again next week. Thanks. Bye.